This is the second part of the instructional video for Chapter 1. We will review the 4 financial statements. Let's start with the balance sheet. The balance sheet lists the company's assets, liabilities, and owner's equity at the time the balance sheet is issued. It is based on the accounting equation, which states that assets equals liabilities plus stockholders' equity. This equation always has to be in balance. Assets are resources the company has that can use now or in the future. Examples of assets are cash, accounts receivable, inventory, supplies, land, buildings, equipment. Liabilities are amounts the company owes in terms of money or work to employees, creditors, suppliers, etc. Example of liabilities include accounts payable, notes payable, salaries and wages payable, unearned revenue. Stockholders' equity represents owners' claims. It is also known as residual equity, or the portion of the assets left to the owners after creditors are paid. Examples of stockholders' equity accounts are preferred stock, common stock, additional paid-in capital, retained earnings, treasury stock. Let's look at Nike's balance sheet as of May 31st, 2011. Please note that this financial statement states a date when these balances were true. We cannot say that cash for 2011 was $1,955 million because cash balance changed many times during the year. Nike presents the balance sheet in an account format, assets on the left and liabilities and stockholders' equity on the right side. Some companies list the 3 categories one after the other, following the order of the accounting equation. We can see that Nike had accounts receivable of $3,138 million. To clarify, accounts receivable balance represents the amount the company expects to receive from its customers for goods sold on account in the near future. Depending on their credit terms, near future can vary, but commonly represents a collection within 30 to 60 days. Nike's inventory was $2,715 million, or they had inventory in stock at this date for that amount of money. The long-lived tangible assets used in the company's day-to-day operations are reflected in the property, plant, and equipment line. On May 31st, 2011, Nike had $2,115 million of tangible property, net of depreciation. This would include land, buildings, machinery, equipment that Nike owns. Nike's liabilities are for the total of $5,155 million and are comprised of accounts payable, or amounts owed to suppliers of $1,469 million, notes payable of $187 million, and other. Their long-lived or long-term liabilities, or amounts that need to be repaid in the more distant future, with a maturity date further than 1 year from the date of the balance sheet, are long-term debt and other obligations. Long-term debt could be generally notes or bonds payable. Lastly, we see the shareholders' equity section comprised of contributed capital of $3,947 million, representing all investments received by Nike in exchange for the company's stock. Retained earnings represent the earnings earned by the company from its inception, less any dividends distributed to the shareholders. As you can see, Nike's total assets of $14,988 million equal the sum of Nike's liabilities and stockholders' equity. The second financial statement we will look into is the income statement, also known as statement of operations. The purpose of the income statement is to show results for a period of time. It lists the revenues, expenses, gains, and losses generated and used over a period of time as stated on the statement. The period could be a year, quarter, or a month. Revenues are amounts earned from services provided or sales completed during the period. Expenses are the resources the company had to use in order to generate this revenue. For example, the company used the work of its associates and in exchange had to pay their salaries. The company has to use the space for the company store or offices, and for that had to pay rent, utilities, maintenance, and cleaning. Other examples for expenses are cost of goods sold, which is the cost the company had to incur for the goods that were sold. Tax expense, insurance expense, or travel expense are other examples. If we are using Nike as an example, the $120 they charge the customer for a pair of running shoes is their revenue. The cost of $50 to make this pair of shoes would be their cost of goods sold. Let's take a look at their income statement for the year 2011. Their revenues are $20,862 million. Noting the length of the period the statement is covering is extremely important. The sales figure may be impressive for a month's worth of work, but very unimpressive if it reflects the activity for a full year. The cost of sales of Nike is $11,354 million. Again, the balance in cost of goods sold represents how much Nike had to incur for all the merchandise they have sold in 2011, or the $20,862 million. The $9,508 million is the company's gross profit, or the difference of the sales and this one expense, cost of goods sold. This is the amount that helps the institution pay for all of their other expenses, and any leftover represents their profits, or net income as it appears on the statement. Gross profit is an informative figure that is frequently analyzed and compared to prior periods and industry standards to determine efficiency of the production process or purchasing practices. You can see that the rest of Nike's expenses are lumped into broad groups: selling and administrative, interest expense, and other. GAAP requires companies to isolate interest expense from their operating expenses, so companies that borrow are comparable to companies that don't. Provision for income tax is Nike's income tax expense for the period. Net income of $2,133 million is Nike's profits or earnings for 2011. The third financial statement is the statement of stockholders' equity, which shows the changes in stockholders' equity accounts that occurred during the period covered. Contributed capital is a major category of stockholders' equity, including all contributed amounts paid by shareholders for common and preferred stock. Examples of contributed capital accounts are preferred stock, common stock, addition paid in capital. Retained earnings is another major category of stockholders' equity section. The balance represents corporation's earning retained in the business since inception. Net income less dividends accumulated for all the periods. On Nike's statement of stockholders' equity, you can see the changes in contributed capital and retained earnings and other equity from the beginning of fiscal 2011 to the end of fiscal 2011. You can see that the balance of contributed capital increased by $502 million because of issuance of new shares. The balance of retained earnings account changed from $6,095 million to $5,801 million because of net income for the period, constituting an increase of $2,133 million, payment of dividends, a decrease of $569 million, and other transactions. If you want to investigate what the other transactions represent, you would need to read the notes to the financial statements where this decrease will be explained. Statement of cash flows shows the uses and sources of cash for the period covered. 3 different sources or uses of cash are discussed. They're resulting from operating, investing, and financing activities. The 4 financial statements are an important part of the financial report. The financial report also includes President's letter, supplemental schedule and notes, independent auditor's report, news releases, and management forecast. We will study into greater depth each one of the statements in later chapters of the course.